how much would this potential $220 billion stimulus in infrastructure help markets when it comes to sentiment improving as well for the country?
Yeah, for sure. I mean, we are very pleased to say is, if you look at our China views, I think the policy easing from China was one of the key pillars we had. So just to quickly back up our views on China, so we have been overweight the market. We thought the earnings momentum and the recovery should sort of come through starting third quarter, and we are already seeing some of that in the higher frequency data in their policy stimulus across dimensions in terms of fiscal, monetary, sort of COVID policy easing regulation. We thought will come through, and already we are kind of seeing evidence of that as well. Obviously, the valuations have come up because of the recovery in the market from the trough, but we think they're still kind of reasonable, and positioning is still light. And so if you back up all of that, we still think China equities should be doing much better than the rest of the world, especially United States, and we are still expecting around 14% upside for China equities this year.
How much will the positivity over China help other markets in the region? Because this chart on the Bloomberg shows how we've seen those tech-heavy Korean and Taiwanese markets really lose so much of capital outflows recently.
Yeah, I mean, we are somewhat more cautious on the global cyclical markets like Korea and Taiwan. So we have sort of tactically taken our view down on Korea from overweight to neutral. We have taken the view down on Taiwan to underweight. And really, I think the risk is more coming in from externally, more from sort of recession risks in the US, because these markets are quite sensitive to that. And so there is a larger amount of earnings downside risk for Korea and Taiwan. So because of that, I think we still kind of like China and parts of ASEAN, including sort of Singapore and Indonesia, which are much more kind of domestically demand-oriented economies, as opposed to much more globally sensitive Korea and Taiwan in here.
So, Neil, does it seem like we have really hit peak inflation, though? And what does that mean when it comes to the adding on of risk for these markets?
Yeah, I mean, that's a great question. I would say in terms of sort of our global views, we are somewhat still defensive overall, and the outlook for the risky assets, I would say, is still near-term challenged view there. And I think the main reason there goes exactly to what you mentioned, which is that we haven't seen peak inflation yet, and we think we would need to see a better sort of mix of growth and inflation, i.e. kind of inflation peaking, but also growth signals kind of troughing there before we see a more sort of firmer pricing in the risky assets. But I would still say one of the core views we have there is that broadly we still are neutral on equities on a global asset allocation basis, but within sort of different regions, we think Asia and particularly China should outperform US, given sort of valuation differentials, positioning differentials, as well as China, which obviously, as we discussed, is on a very different cycle compared to US.
What about earnings expectations? Are they at a level now where we could actually see a chance of upside surprise?
I think, again, for earnings, we do think, for example, in China, as I mentioned at the top of the call, as the macro recovery comes through, we should see better earnings in third quarter onwards. For the rest of the region, we have actually taken our numbers down somewhat, but that, again, comes from globally sensitive markets like Korea and Taiwan. And so we still think there could be further downside risk there. But I would say even in US, we have taken our numbers down for earnings a couple of percentage points, and we still think that the consensus expectations for margins look optimistic. So there could be still a little bit more further downside risk on earnings, in general. But China, again, kind of stands up much better than the rest of the globe.
So, Neil, on the other hand, which regions and assets outperform when recession risks are rising or during a recession as well?
Yeah, I mean, again, just to sort of circle our views on recession in there, we generally think there is a 30% chance of recession in US, around 40% in Euro area over the next 12 months. And so recession is not our base case for this year, even though I guess the market is kind of pricing a much higher risk of it. I would say in terms of assets which perform generally in recession, it surely is commodities, and equities generally fare sort of more neutralish, and there I think defensive parts of the markets do much better. But the best assets when you sort of look at recessionary periods are commodities, real assets in general. We are overweight cash as well, And within equity sectors, we think financials should be doing much better because you're generally accompanying with a tighter rate cycle as well.